And what happened in the next couple of days? Almost nobody is talking about it. This changes everything you thought you knew. Because while everyone is celebrating this rally, something far more dangerous is building underneath, a silent imbalance, 6 years in the making, and now it's reaching a breaking point. Yes, you heard that right. 6-year deficit, 6 years straight. Supply has been losing to demand every single year since this cycle began, and here's the part no one is telling you. The physical silver is disappearing. Quietly, systematically, vaults are draining, while paper markets pretend everything is completely normal. I know what you're thinking right now. If supply is collapsing, why hasn't price already exploded? Why isn't silver at 100 or even higher right now? Because this market doesn't break slowly. It snaps violently, suddenly. And when it does, most people are completely unprepared, just like what we saw in the last spike. In fact, the last time this exact setup appeared, silver didn't just rise, it went parabolic, fast, aggressive, and then it trapped almost everyone on the wrong side. Now the same conditions are forming again. But this time, the deficit is deeper, the inventory is thinner, and the risk much bigger than before. So the real question is not if silver moves, it's when. And more importantly, will you be positioned before it happens or reacting after it's already too late? Right now, silver is trading near $79. But this move didn't happen randomly. It was triggered by a critical report revealing something most traders completely underestimated about supply conditions. A major research report just confirmed silver is heading into its 6th consecutive year of deficit, not 1, not 2, 6 straight years where demand keeps overwhelming global supply. Let me simplify this. Every year, more silver is being consumed than produced. That gap doesn't disappear, it accumulates, and eventually it forces the market to reprice aggressively. Since this cycle began, over 700 million ounces have been drained from above-ground inventories. That's not theory. That's physical metal leaving the system, permanently tightening available supply. At the same time, supply isn't growing fast enough. Mining output is stagnating. New discoveries are limited. And production costs are rising, making it even harder to increase future supply meaningfully. Now here's where it gets interesting. Industrial demand is slowing slightly due to economic weakness, but investment demand, it's rising rapidly as investors quietly accumulate physical silver behind the scenes. Coins, bars, and private holdings are increasing. Not loudly, not publicly, quietly. This is not retail hype. This is calculated positioning by those who understand what prolonged deficits eventually lead to. Meanwhile, the market appears calm. Prices are moving, but not exploding, and that creates a dangerous illusion. It makes traders believe everything is stable, when in reality, pressure keeps building underneath. Because silver doesn't behave like a normal asset. It stays quiet, compressed, controlled, until suddenly it breaks structure and moves faster than most participants can react or reposition their trades. And right now, multiple signals suggest that compression phase is nearing its end. Not confirmed yet, but the ingredients are there. Supply tightness, rising demand, and shrinking inventory buffers across markets. I have been wrong before. Markets can stay irrational longer than expected. But historically, prolonged deficits like this do not resolve quietly. They resolve with sharp, aggressive price revaluations. So what you are seeing today is not the full move. It's the early stage, the setup phase. The part most people ignore before the real volatility and expansion begins. And this is where most traders make their biggest mistake. They wait for confirmation. They wait for headlines. By the time those arrive, the majority of the move is already gone, which brings us to the real problem. If everything looks bullish, why hasn't silver already exploded? What is still holding this market back from triggering that next aggressive breakout? To understand that we need to look deeper, beyond headlines, beyond price charts, into the actual mechanics controlling this market, because that's where the real story begins. So what is actually holding silver back right now? If supply is tight and demand is rising, why isn't price already exploding? The answer lies inside the structure of this market, because silver doesn't trade like a normal commodity. It trades through a system dominated by paper contracts, and that system allows far more silver to exist on paper than physically available. This is where most people get it wrong. They think price reflects physical supply. It doesn't. It reflects derivatives, futures, and leverage positions that can suppress or delay real price discovery. On exchanges like Comex, massive volumes of silver are traded daily, but only a tiny fraction ever results in actual physical delivery. That creates a strange dynamic. Price can stay controlled even while real-world supply is tightening, because most participants are trading contracts, not demanding actual metal from the system itself. Think of it like this. If everyone holding paper silver suddenly asked for delivery, the system would struggle, because the physical metal simply isn't there in sufficient quantities. And this is not a conspiracy theory. It's a structural reality of how futures markets operate. High leverage, low physical backing, and constant rollover of contracts without delivery. I know what you're thinking. If that's true, why hasn't the system already broken? Why hasn't there been a massive default or failure exposing this imbalance to everyone? Because the system has buffers, inventory reserves, leasing mechanisms, and most importantly, confidence. As long as participants trust the system, they rarely demand physical settlement in large numbers. But here's the problem: those buffers are shrinking. Inventories are being drawn down year after year. And confidence? It starts fading the moment volatility spikes or delivery pressure increases suddenly. And that's exactly what creates a squeeze. Not slowly, not gradually, but suddenly. When too many participants move at once and the system cannot absorb the pressure anymore. We've seen glimpses of this before. Short spikes, violent moves, moments where price disconnects from expectations and moves aggressively in a very short period of time. But those were only partial events. Controlled, managed. This time is different. Because the deficit has lasted longer, the inventories are lower, and the margin for error is shrinking rapidly. So the real issue isn't just supply and demand, it's the mismatch between paper claims and physical availability. And that mismatch is growing larger with every passing year. At some point, that gap has to close. And when it does, it doesn't happen smoothly. It happens through rapid repricing, where the market suddenly adjusts to reflect physical reality. Now, to be fair, there is a bearish case. If demand weakens significantly or economic slowdown deepens, pressure on price could continue, delaying that explosive move further into the future. But here's the contradiction. Even with weaker industrial demand, the deficit still exists, which means supply is structurally constrained regardless of short-term fluctuations in consumption patterns across sectors. And that's what makes this setup so unusual. Normally, lower demand balances the market. Here, it doesn't. The imbalance continues, quietly pushing the system closer to a critical point. So what you're looking at right now is not manipulation alone. It's a fragile structure trying to maintain stability while underlying fundamentals are slowly pulling it in the opposite direction. And when those forces finally overpower the system, the move will not be subtle. It will be fast, aggressive, and completely unforgiving for those positioned on the wrong side. Which brings us to the most important question. If this setup is real, how big can the move actually get? And what does history tell us about similar situations? Because this is where data matters, not opinions, not headlines, real numbers, real historical patterns. And when you look at those, the picture becomes far more explosive than expected. In the next phase, we break down exactly what happened the last time silver entered a similar structure and how that move unfolded step by step. Because if history repeats, or even rhymes, what comes next could redefine how this entire market is priced going forward. And most people are not prepared for that scenario. Now let's talk about data, not opinions, not headlines, real numbers. Because what we're seeing right now in silver is what traders call a structural deadlock between supply and demand. A deadlock means neither side can adjust easily. Supply cannot increase fast enough. Demand does not disappear. And that creates pressure that keeps building until the system finally breaks. According to recent data, silver has been in deficit for 6 consecutive years, with over 760 million ounces drained from inventories since 2021. That is not a small imbalance. That is a systemic drawdown of physical supply. And historically, when inventories decline like this, markets do not stay stable for long periods. Now combine that with how a silver squeeze works. When demand surges, short sellers are forced to buy back positions, creating a feedback loop that accelerates price movements rapidly upward. We saw this pattern before. In previous cycles, silver moved aggressively when supply stress met rising demand. Not gradually, but in fast, sharp, parabolic bursts, catching most traders off guard. In fact, during major historical squeezes, silver prices have moved hundreds of percent in relatively short timeframes. These are not normal rallies. These are structural repricing events. And right now, the ingredients are similar: persistent deficit, inventory drain, rising investment demand, and a paper market still dominating price discovery despite tightening physical conditions underneath the surface. This creates what traders call a compression zone. Price appears controlled, movement seems limited, but internally, pressure builds quietly until one catalyst triggers a sudden breakout. And that catalyst does not need to be huge. Sometimes small triggers like volatility, spikes, or demand shifts can unlock massive moves when the system is already under stress. Recent projections show the silver deficit is expected to widen further, even with weaker industrial demand. That means the imbalance is structural, not temporary, reinforcing long-term upward pressure on prices. This is why many analysts are now using terms like silver deadlock and supply shock, because the market is no longer adjusting normally. It is compressing under conditions that historically lead to violent moves. But here's where things get even more interesting. Despite all this data, the market still hasn't fully reacted, which raises a critical question about what happens next. Because if this deadlock continues, and if a true silver squeeze begins, the price movement could be far more aggressive than most current forecasts are suggesting right now. So now we move to the most important part: what happens next? The scenarios, the triggers, and the exact levels that could confirm whether silver is about to break out. So what happens next? There are only two realistic scenarios for silver from here: a controlled breakout or a delayed explosion that catches almost everyone completely off guard. In the bullish case, silver breaks above key resistance levels and triggers momentum buying. That's where algorithms, institutions, and retail traders all start chasing the same upward move. Once that happens, the move can accelerate quickly, because in a squeeze environment, price doesn't wait. It expands rapidly as liquidity disappears and buying pressure overwhelms available supply. In the bearish case, silver remains stuck in this deadlock phase longer. Prices move sideways, volatility stays low, and the market continues building pressure without releasing it immediately. But here's the key point. Even in the bearish scenario, the structural deficit does not disappear. It continues building silently, increasing the probability of a much larger future breakout event. So both paths lead to the same destination: movement. The only difference is timing. Either the breakout happens soon, or it gets delayed and becomes even more aggressive later. Now here are the three triggers you need to watch carefully: rising volatility, increasing delivery demand, and sudden spikes in investment inflows into physical silver markets. If these signals align, that's your confirmation. That's when the silver deadlock breaks. And historically, that moment is where the fastest and most aggressive price movements begin. I have been wrong before, but the data is clear. Prolonged deficits, shrinking inventories, and rising demand rarely end quietly. They resolve with sharp, violent repricing events. So if silver closes above $80 tonight, pay attention, because that could be the early signal that this market is finally transitioning from compression into expansion. And if you want to stay ahead of this move, not react to it, then this is where you need to be. Because timing matters more than direction in markets like this. Subscribe now. Because if this breakout confirms, I will break it down step by step. No noise, no hype, just data, and what you need to watch next.